So one of the big topics right now, as we can see in this chart here, is that the lending standards are nothing like the early 2000s. In the early 2000s, from about 2000 to 2008, the product risk, which is that upper echelon there, was super high versus the borrower risk. And then as you see, as we go through 2009 all the way up to 2015, that number, that gap between the product risk, which is the mortgage, and the borrower risk, which is us as consumers that are getting the mortgages, is almost flat together. So that way it's pretty even, which means prior to 2008, there was more chances of the borrower defaulting on the loan because there wasn't as strict standards and lending practices. As they tightened that up, the risk to the bank decreases, and now people who think, oh my goodness, we're gonna see 2008 all over again and the market's gonna crash, you look at it, a lot of these people that bought homes, remember 30% of the transactions are done in cash right now. The other 2/3, people are qualifying, which means they're not gonna lose their home. Keep that in mind when you're thinking about, is the market gonna crash or not?